Hi guys, welcome back to another weekly segment where Mike and I go over you guys' topics, comments, and questions. Today we had a great topic. Before we get into that, I have to say my usual, make sure you guys like and subscribe. All comments help the algorithm, and we really appreciate the support. Keep the comments coming in. Help that algorithm, baby. Really appreciate
Like
it.
that shit.
Yeah, we like that. Today, today's topic is, hi Michael, thank you for everything you do. I understand your perspective on the merits of focusing on higher time frames over intraday trading. For smaller accounts like 30K, isn't there a potential for faster capital growth in intraday trading due to compounding/capital recycling and removing overnight risk? This might be a naive belief, but I genuinely value your insights. Would you consider elaborating on this topic in one of your upcoming episodes? Here we are.
We're here. We're here in the ever-evolving moment of right now. So, that's a complicated question, and there's I don't want to get long-winded on it, but I feel like there's a lot to that question, and it's kind of like if you're a witness in court and the attorney asks you a question, assuming a certain type of logic. So the first thing I'd say is you don't want to remove overnight risk. That's where you get paid. You get paid to have risk. So it wouldn't be my style. I know everyone has to do things their own way, but I've just benefited so much from having risk overnight and just waking up to winners that just keep going. And so I like to try to get into positions small at first, build my position over time, which can be day after day. It all depends on what the price does. That's the trigger that I use to enter. No indicators. And then my expectation is that the trend is going to continue. It doesn't always work that way. But that's my expectation for my style of trading. There is a theory out there, and I know where it comes from. So when you run a back test and you have your entries and your exits, you have your money management rules all in there. You bring in your universe of securities. You're testing over 10 years. You're not just looking at one instrument. And then you see the distribution of returns. You'll likely see a big cluster around the mean, which would make sense, right? And so then on the tails, you might see a big loss because one of your stops. And for me, that's probably twice. 2 times, you'll see, in other words, 2 instances of outsized losses, like where your original bet sizes are, and your expectation is to make 3 or 4R, and you might see a 3 or 4 or 5R loss. How does that happen? Well, markets can open sharply against you. In my experience, that happens once or twice over any rolling 10-year period of time. So for me, it's statistically insignificant to worry about that. It's like worrying about the boogeyman crawling out from underneath your bed. So now that doesn't mean that it can't happen, and it's not to minimize the effects. But in that is where you have to control, and we'll answer that kind of like, I think there's another question we're going to do for next Wednesday that talks about a big many standard deviation, move against you. That all gets covered in your bet sizing. Now, when you look at your normal distribution, you can see that there's a greater percentage in the back test of gains that could be anywhere between 0 and, say, 3R. Those returns are dictated by the rules that you put into your system. For discretionary traders at home, they're looking to, buy X amount of, a risk unit of X number of contracts and deliberately sell at 3R. My rules don't work that way. I don't want to cauterize winners until the market tells me the move is over. So it's a very, very different approach than where I think the question's coming from. So what that does is that it does show that if you did a back test, there is a cluster of smaller, 3R, 0 to 3R gains by those systematized, no discretion trading rules. So if a person was looking at that data, they'd say, there's just many more. In terms of frequency, there's many more smaller moves. So what I'm going to try to do is hop from lily pad to lily pad to capture those moves intraday or from one day to the next. The problem is most people can't do that. So just because we can say that there is an existence of a higher frequency of smaller gains, trying to capture those smaller gains is still the same thing that the 94% of the people who are trying to day trade and fail try to do. So if you want to have at it, you're only going to know by trying. Don't listen to me. I just found for myself, and having studied the data, not the charts, there's a big difference, that I needed to open myself up to having what I called good risks. And a good risk at the beginning, a good risk changes, the definition changes. Good risk at the beginning is I have a trading signal, I put the trade on, that's a good trade. Why? I followed my rules. What's the next thing as soon as that Gerard calls and says I have a fill? Okay, let me give you another order. What do? I enter my protective stop. That's also a good trade. Because the best I can do is stick to my discipline and stick to my rules. Now, as the move progresses, I have tactical spots where I add and try to work into my optimal spot. I'm only concerned really with the trade once I'm fully loaded. That's when things get interesting for me. That's what I'm working for. Is I'm working at the beginning. It's like you go to a nice restaurant, you know you get a 7-course meal. I'm not excited about the first course or the soup or the salad or the little intermezzo to clean my palate. I could give a shit. For me, it's the whole experience, but the main event is the entree. Sometimes it's the dessert because I had a sweet tooth. But so as I'm anteing into the pot, it's because I'm playing Texas Hold'em with the market, and I want to see more cards. I'm not going to bet big blindly like some of these jackasses do. It doesn't make any sense from my temperament, my personality. So yeah, I'm being a little judgmental. But it makes no sense because it speaks about ego. It says right here, right now, I got to buy 11 contracts of something, and this is the one price to do it. It's certainly one way to do it, but I think that also ensures, volatility, unexpected events, this and that. So if you look, it really depends on how do you want to get to a certain number. Let's pick a number like 60. Because there's a million factors that go into the number 60. 1, 2, 3, 4, 5, 6. You see where I'm going with this? So if your goal is to make 60% on a trade, right? How do you want to get there? Do you want to have 3 trades that give you 20%? Do you want one that gives you 60? Or do you want, 12 trades that give you 5. You see? Because I'm trying to do it in such a way that I don't have to do it with a lot of frequency, as in the number of trades. Emotionally, I'm comfortable with taking risk home overnight and over the weekend, long or short. Doesn't bother me. And that's directionally with the underlying instruments. And it's if I use options, I'm normally a buyer. So I'm long option premium as a debit. Typically don't do, multiple option strategies like spreads because I don't want to capture or corrupt my upside. I put an upper boundary there. So this starts with what's your emotional makeup. Do you want to be busy every day, right? Because that's where most of the people fail. If you let the markets do the work for you and you can catch the right move, the market will do the work for you instead of you having to sit there, double-clicking your mouse all the day and watching screens and having multiple monitors. That's why I don't need any of that stuff. And so you want to really ask yourself, too, like, do you want to be a trader? Do you want to look like a trader, right? It's like that scene from The Departed. You know what I mean? Do you want to be a cop? You want to look like a cop.
Right.
And so all that macho stuff never really resonated with me because I never had that vein, thank God. You have to spend so much energy and money to maintain that, and it's an empty way of going about life. It's really up to you. I haven't found that knowing that there exists, a greater frequency of smaller trades and a smaller number of bigger trades, if you do the mathematical products, meaning the number of trades times those gains, and you do the math, for me, the math works better when I look for fewer positions and larger gains. It depends what your emotional makeup is. You know what I mean?
Yeah, well, I mean, you kind of touched on this too quite a bit. I think that when you're making like a lot more moves, you're kind of opening yourself up to like a lot more mistakes, and your setups aren't technically going to be like as good or as well researched, and you could die from death by 1,000 cuts, as I've heard you say before. And I feel like as a I'm just assuming that this person's a beginner or fairly new. I feel like opening yourself up to more mistakes like that, can be like really mentally taxing, right? Especially if you're like monitoring it like all day, like 5 small mistakes versus one, sort of not medium-sized mistake.
Yeah. I mean, you sound like me. Actually, you're smarter than me. He's smarter than me. Where's the camera? He's smarter than me. He's smarter than me. So the thing, too, is like for the untrained eye, it makes you think that there's this opportunity there, right? Because you're like, here's the evidence. It doesn't mean you're entitled to it, though. Like,
Right.
you have to do the work. So what happens? You sit there and you put on a trade because you think your criteria are hit. It doesn't work. So now you do it 2, 3, 4, 5 times. I get emails from people who put on 20 trades in a day. I'm like, what are you doing? You're not trading at that point. That's not trading. That's feeding some other emotional need. And so without a set of rules that works, and with an ironclad sense of discipline and a really good attitude, doing this kind of activity is exactly why and how people go on tilt. It's because they've put on so many trades and lost, they can't take it anymore emotionally.
Yeah.
Whereas for me, I'm just putting in my ante. I'm putting in my big blind, my small blind. Maybe there's an ante because I want to get 2 hole cards. Then if I have decent hole cards and I'm in position, I might, pay to see the flop. Sometimes I'll vary my behavior because you have to keep everybody guessing, and you play shitty cards from out of position because you have to show the board that you'd be ready to do that. You can't just play strong cards because anytime that you make a big bet, everyone's going to fold if they figure you have the nuts. So, but at any rate, poker analogies notwithstanding, I would recommend for younger people to not actually think about day trading, even if you have a smaller account. Think about buying quality stuff that's in an uptrend and then stay with it. Even if it goes down against you a little bit from one day to the next, it's not the end of the world. You can't be so emotionally attached to your small account. And again, I know I go against the grain on saying these things because most other people are like, if you have a $5,000 account, get lost. Get off my Instagram, you idiot. We all know who I'm talking about. I find it that a lot of people are kind of gullible because they kind of hear the stuff that they want to believe, and that's what they go towards. I have to have integrity. I don't care if everyone unsubscribes from the channel. I have to shave my own face in the morning. I can't say the things that I think people want to hear. Because also there's no integrity with the audience, then there's no integrity with myself because I haven't lived it. I don't have any, as Immanuel Kant would say, a posteriori knowledge of that. I can see in the back test that there are clusters of gains, but those weren't because I took those gains deliberately. It's because the criteria of my sell strategy was hit. But it was all mechanical. I had nothing to do with it. Now, there are some times when I'll step in and I know the market's turning and I can see there's a reversal at the top. I won't wait for my protective stop to get hit. I'll protect my capital and then cancel my protective stop. But that isn't something that comes lightly. It's not something that I just say, yeah, I feel like doing this today. I need the win, so I'm going to do it. It comes from 35 years of experience. And I have an enormous feel for the markets. When you're just starting, you don't have that. So you can't be like me. You can aspire to be like me or anyone else who you might look up to. And I'm grateful to have, the fans that I have. But I think it's misleading to say that you want to go for the low and the smaller win, because at that point you kind of build yourself into being the small-time trader. And once you get into the mindset and being in the habit of the small trader, it's hard to get out of being a small-minded trader. You have to want to get there. And the easiest way, what's the data? 66 days now to break a bad habit and replace it with a new one.
Yeah.
The best way to avoid that is to not put yourself in a bad spot in the first place. And that's awfully difficult when you have that $5,000 account and you're trading micro contracts and you think 50 to $100 is a lot of money. I mean, it's all relative, I know. But that's why I advocate folks thinking in terms of percentages and not dollar signs. It's the quickest way to start improving your performance because, even if it's the same thing, if you lose 0.5%, right? Or if you look at dividing your money by whatever your risk unit size is, right? So if you start like I do sometimes with like 0.1%, I got 1,000 mistakes in my portfolio. And the probability of me, evacuating my capital for having 1,000 trades in a row that lose is so small as a probability. So if you do 0.5% risk units, you have 200 mistakes. If you do 1/4 point risk units, you have 400 mistakes. That's really how you want to look at it. Divide your money, right? If you have 1%, well, now you have 100. Divide that in half, then the number goes up so that you have 200, 300, 400. And then you cut it again to 0.2, let's say 1/5 of 1%. You got 500 mistakes in your portfolio and or losses. So if you lose money on a trade, you don't care.
Yeah.
There's no big deal. I think there's a fundamental misunderstanding about how trading works, how compounding works as it relates to trading. And two, again, this is my theory, my philosophy. You can disagree. I don't want this to become labor intensive because then it becomes a chore. And how do you behave when things are in a chore? Are you doing your best work? Not typically.
Yeah.
Unless you're a dutiful, like, little taskmaster and you like raking leaves and cutting grass. I did that for 10 years, and I did it, and I made a lot of money at it. But I don't want to take that mindset into trading. I need to think abundantly.
Well, yeah, and that's one of the things I was actually going to bring up, too, is, like, we talk about going on tilt quite a bit, and, like, that happens. But I don't think a lot of people realize that. Yeah, I feel like some people are probably watching this, and they're like, I'm not on tilt. I'm not angry. What do you mean?
Listen to your voice.
And it doesn't. Right?
I'm not on tilt, God.
Well, and a lot of it, the people, I think, fundamentally also misunderstand what tilting is. And tilting doesn't have to be angry. It doesn't have to be driven by anger. It could also be driven by apathy, and then you put yourself in the spot, like you just mentioned, where you have to be, dutiful and just kind of, checking off the boxes, on the list. And, like, you don't do your best work like that. You never want to bring that, like, apathetic stance into what you do. So I think that's part of it, right? Like, if you make that many mistakes and you're dying death by 1,000 cuts, each mistake adds to, your sense of apathy towards whatever it is, life, trading, whatever. And I feel like that's probably worse, especially if you're like, if you think about it, if this person has a smaller account and they've, wrecked, I don't know, let's just say like $1,000 from recent trading activity. And over time, they're like, dude, I just lost like a month's worth of work or like a year's worth of work. This sucks. And then they're just like on a form of tilt, right?
Yeah.
Because they're kind of in that like depressive, apathetic state towards what they do. And then there's like no coming out of that. You got to find a motivation or a discipline. Whereas if you put yourself in a good situation in the first place with better habits and, like tested strategies, you wouldn't be there in the first place.
I agree 100%. The thing I can tell you from history is that the industry in there, because there's always unintended consequences, right? We don't talk about that enough. So when I started, the S&P contract was $500 a point. Then there was another one that actually didn't have as much liquidity. That was $250 a point. And the margin was like $40,000. It was insanely hard to trade it. It was largely institutional. So with the prevalence and the advent of the internet and people coming online and discount brokerage, the folks at CME, because this was before all the mergers and the indices and the currency futures contracts traded at the Chicago Mercantile Exchange, they said, well, we're going to make this more available to the smaller investor, smaller trader. So they cut the S&P contract by 90%. So now the E-mini, as it's known, the ES contract, is a lookalike of the Big Daddy, but it's only 1/10 the size. And so what they've done, and then they cut the margin too, right? So now it's prevalent. It's one of the most popularly traded instruments that's out there. But the disservice is that it's one of the most popularly traded instruments out there. because people come to the market and they don't know what they're doing. And so you have to remember the exchanges provide you a platform where you have to do all the work. It's almost like publishing a book anymore. The publishers don't really do much other than help you build the book, which is easy enough to do. And so it's not really worth it financially. Plus, you have to do all the marketing. So they really don't provide much value, at least for someone at my stage of expertise. And I think when you don't, the educational videos are very flaccid. And I use that word deliberately because we all know what it refers to. And that's what they are. I look at the videos and they're like, here's how the contract works. And here's you post margin when you put on a trade. And here's maintenance margin. And each tick value is this. That doesn't help people trade. That's like the ingredients on the side of the cereal box. Doesn't really tell you anything about how to make money. Now, they can't tell you that trading is hard. They can't tell you that 95% of the people that try to do it fail, because then you're not going to do it. And they get exchange fees. The members get commissions and clearing fees, right? Because there's two parts to that. Then if there's high-frequency traders, which are all over the E-mini, they might make, a fraction of a tick because they're betting on you being your own worst enemy. No one's doing this for altruistic purposes. It doesn't say 501c on their foreheads, right? These were member-owned exchanges that went public that are now owned by shareholders. There's nothing nonprofit about it. And so there is a big problem in the industry where you make it sound that it's so easy. You just fund your account, you log in, you can trade, you've got the app, then we just have no commissions, this and that. And if they really had integrity, they'd tell you that they give you these risks like, trading futures is risky. You could lose all your money and then have to deliver your house as a margin call. That's all interesting, but they don't tell you that the majority of people who try it fail. Then there's a few others that kind of are plus or minus a few percent, let's call them break even, and probably 1% to 2% go on to make some money.
Right.
Not a lot of money, but they're profitable. So that's why we always focus on goal setting, because if you're not super clear about what it is you want out of the situation, it isn't going to come up and kick you in the ass when you're not looking. The only things that happen when you don't have goals are bad things, because you're not anticipating. You don't have a plan. You don't have a contingency. You don't have the what ifs. And that's why you're not responding to situations, you're reacting. So it gets super deep. The question, it presumes a lot of things, but I don't think that the potential frequency of smaller winners would keep the velocity of your capital performing. If you have 20 years of experience as a day trader and you've already done it, then you could prove me wrong. But if you're just starting out, you just don't have the chops right now to live in that reality. There's a big gap that you have to, even though you can see it, it's right there. That doesn't mean that you're going to get those gains just because of their availability. You see what I mean?
Yeah, for sure.
Yeah.
I think, kind of going back, I kind of thought of this while you were talking a little bit. I mentioned that it's, in my opinion, it would probably be a little more strenuous. I mean, at least relating to like the stuff that I do with gaming, making a lot of small mistakes adds up, and that's the stuff that drives you crazy, actually drives you crazy.
Yeah.
And I feel like for a lot of the people making all these moves, I guess the best way I can relate it, in a way that people can understand when they're not blinded by, tilt, is kind of like if your business partner or your husband or your wife is just texting you or just doing something, reminding you about one specific thing, one mistake that you made all the time. If they did it once, no problem, right?
Yeah.
If they did it 25 times in a day,
yeah,
that's a problem all of a sudden, right?
It is, yeah.
And I feel like it's kind of the same thing with making a lot of moves, making a lot of small moves, right? It's kind of a small thing, being reminded about something, a mistake you made, or hey, make sure you take out the trash, whatever. But, if you're reminded 25 times in a day, that starts to add up and, drive people kind of crazy.
Another great point, and that's what happens in amateur land, which is where we all live when we're starting, is you don't see the P&L, you see the frequency of the losses. And so thinking in terms of percentages is number one. Two, learning how to understand emotionally, not intellectually, emotionally the concept of expected value, where the frequency of your losses can outnumber your winners by a big magnitude, 3-1, 4-1. But if with the right buy-sell decisions, you can still make money with that model. Your accuracy is a failure, but you don't have to necessarily be accurate in order to make a lot of money. You have to understand. That was probably the single most important thing that I needed to understand in managing risk, was the concept of mathematical expectation. You know, the funny thing is I knew it because I was a math whiz. I understood it. I just didn't know that it applied to trading. And I mean, I felt it physically when it hit me that was what the trading game was about. Was in order to thicken your skin, so much like you get a paper cut, it feels like a sharp little, quick little pain, but then after 30 seconds, it's gone. There's really no blood. So now it's just like, I have skin of a shark. Nothing bothers me. You know? There's no point in it. There's no way to make money by getting upset over how any one particular trade works out. Because over my decades of experience, I know that those 5 to 20-yard trades are going to be there. It's not when I want them, it's life on life's terms. So if you want to drive yourself crazy and be anal, by all means, start with an underfunded account, trade the micro, watch every tick like your life depends on it, and drive yourself crazy and eat yourself alive from the inside out. That's not the life that I want to live. And I don't care about the money. Granted, I could sit here again after 30-something years, and I don't need the validation that the newcomers do. So there's all of that built in. So that's the reality of trading right there, is that you're emotionally invested in the outcome of every trade. You need to see the winners for your self-esteem. You want to be validated as a trader. Day trading the E-mini, it's not going to get you there. What can get you there, because time heals all wounds, it heals those paper cuts too. If you have a winning trade and you can just sit on it and let it work for you, you'll end up making more money than you could have fantasized about having made. And that was the ego list. That's when I had to surrender. That's chapter 2 of the book. Surrender. You don't know everything. I don't know everything. I can't tell what the magnitude of any move is going to be ahead of time. I have no damn clue. But I know by sitting on my hands, I put myself in a spot where I'm going to always be in the right place at the right time. I can't lose.
Yeah.
That's how you can time the market better, is by constantly leaving good risk on, right? So going back to before, what's a good risk? Entering the trade in the first place, putting in your protective stop, getting fully loaded. Then the best trades are letting those fully loaded positions go and being comfortable that the outcome is going to vary, and that I can't go in and just say, okay, I'm up 1% on my equity, I'm going to cauterize the win. It's because for my style, I'm trying to get fully loaded, which doesn't happen typically in a day. So then it's like there's so many false starts, because I'll get into a spot with like a small risk unit, get knocked out. I'm like, okay, no big deal. So then when I can finally get fully loaded, that's when I want to let the wind of the market push into my sailboat so that I can enjoy the ride. And just sit back, adjust my protective stops. And I'm happy to take a smaller gain. I'm emotionally and financially okay with taking a smaller gain by just always ratcheting up my protective stop on a long position to let the market move in my favor, because I don't really care. I'm in the trade to get as many R's as I can out of it. But when the thing is all done, as long as I followed my rules, emotionally I'm indifferent of whether I took a 6R or a 4R trade. I don't care. When you're younger, again, you need the validation. No one's talking about that, but that's what everyone needs. Daddy, did I do a good job? You know what I'm saying? Like, who's your daddy?
Well, it's just you communicating with the ego, you know? That's pretty much what it is. It doesn't even have to be from other people. It could just be your own ego you need validation from.
Yeah, and 100%. That's a really good point. And when you're just starting out, you want to feel self-assured, and I think that's reasonable, because I want that too. But I don't look at my performance on the as P&L.
Yeah.
I look at my performance as like, did I act were my actions, because I'm doing a post-mortem now, were my actions and are my actions going forward congruent with what my goals are, right? Because I'm not looking for 12% in managed futures. It's not worth my time. So you need to know what your worth is and why do you do what you do? What do you really want out of it? I promise you at the beginning, most people, and I'd say I'm not a psychologist. I don't think you need to be one, but you need to understand yourself. And at the very beginning, I think the emotional payoff is probably more important than the financial payoff. And over time, you kind of numb yourself in a good way to just not caring about that, because you are your behavior.
Right.
So you just do the same thing every day. I'm powerless over the results, right? It's a very sober 12-step way of going about stuff, right? I focus on my actions. I know my actions are congruent with my goals. My behavior predicts where I end up. I don't care about any given day. It's not statistically significant, because you got to think about it. In 4 years, you're going to have 1,000 trading days. If you lose your discipline, you can get really hurt. But as long as you use protective stops, and that's the challenge. Can you invite yourself? Do you love yourself enough and give yourself permission to stay in a winning trade overnight so that you can make your first 5-hour trade? Because then you can get used to that, but you have to be willing to do it once.
Right.
And I don't, people talk about irrational fears. Fear is fear, I think, in many ways. But for some reason, and I don't know where it comes from, there's this, I don't even know what the right word is. I guess it's irrational fear about overnight risk, and it makes no sense to me. It's like the only thing that can happen overnight is bad stuff. And in strongly trending markets, that's where the juice is, right? Because there's a whole wave of buyers that haven't stepped up yet, and they're sitting and they're cogitating overnight. So you have to think what your competition's doing from an art of war standpoint. The victorious warrior first wins, then seeks battle. So I've already mapped the situation out in my head on how I'm going to handle things from a tactical standpoint. Then everyone who has to come in to the trade, especially after I'm fully loaded, has to pay me the admission ticket to a game that I'm already in. Yeah. And that magic happens overnight and over the weekend. And someone wrote in a really stupid comment about looking at the day's range and all this and that. But again, just because you can see there's an existence of volatility or a certain day's range doesn't mean you can capture that. First and foremost, because you can never buy the low and sell the high. You can never short the high and rebuy or cover at the low, right? So that's not terribly practical. Again, I study the data, so I spend hours and hours looking over where are my blind spots, where am I making assumptions, where am I data mining, where am I curve fitting, which is why I don't use too many parameters or other things. It's largely price for entry and exit. So, good question. It's a pretty deep question. There's a lot of things that were left unsaid because where the question comes from, it sounds as if the person's listening to a lot of people, and admittedly, look, I don't mind that there's people hustling on the internet trying to make a living, but the folks out there that are trying to coach don't really have the experience to kind of do what I do as far as I'm concerned. Now, true, if you go to high school and you look up, you're a freshman and you're looking up to the juniors and seniors because they're considered upperclassmen, I get it. I've been in those situations before. But then there's a day, as long as you do what you're told, that you'll get to be a junior and a senior, and you're an upperclassman. And you realize at that moment that there's nothing special about that status, if you will, than you survived a couple of years. And that the only thing different now between being a senior and a freshman is 3 years. There has to be some bottom line behavior for sure to kind of graduate. It's not terribly difficult. But I think the folks out there that are giving you advice are selling you only fractions of the truth because they want you to join their discard or they want you to buy their education program. Right? We talked about that. There's oftentimes, most of the time, there's no compatibility between the person who's buying the system, if you will, even though if they understand the rules from an intellectual standpoint. That's what makes this so difficult. You can only count on yourself. You really can't buy a way into calming your nerves unless you smoke a lot of indica.
Yeah. Yeah, no, for sure. I think we kind of touched on all the points for that question. I think I hope we had a good amount to add, and we appreciate the comments as usual. I think it's a good place to wrap up here. And with that said, thank you guys so much for all the support. We really appreciate it. Make sure you guys like and subscribe. All comments help the algorithm, and I will see you guys in the next one.
Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.